Michael Landsberg, Chief Investment Officer of Landsberg Bennett Private Wealth Management, is with me. And so what is your big picture? I do want to get into some specific stories, but what's the big picture here on the market?
I think stocks are acting quite well. Obviously, earnings in the last quarter were very good, up 12% year over year for the S&P and up over 22 on the NASDAQ. So earnings are still, I think, in pretty good shape. Concerns I have, as usual, is about 5% of stocks are making all-time highs while the S&P is making all-time highs. Again, it's not a broad leadership. It's a very narrow and tight. I think that's a little bit of a concern, and hopefully we get past some of this tariff stuff with China. But I think overall things look pretty well for the second half of the year.
Understood. You know, the geopolitical story is something you're certainly, and most investors are focused on. What are your thoughts there?
Yeah, my hope was we got some kind of resolution with the China scenario coming up in a couple of weeks. It appears as though we may have seen some stuff that came out of the Commerce Secretary that maybe they've made a couple deals. That really was the only thing I kind of worried about from a tariff standpoint. We seem to get away from talking about it because obviously with Israel and Iran and that situation over there, and I think that's gone away. So hopefully some of these roadblocks I think get kind of settled to the side. We should be in a decent half of the second half of the year with earnings and again where stocks are going to be.
Okay, so at this point now, let's talk about opportunities for investors at home and abroad, because I know you do see opportunities outside the U.S. But let's talk about here at home. Valuations are of concern, at least in some stocks. Where is there opportunity in the U.S.?
It's a great point, Nicole. There are some pockets of the market that are priced to perfection, and they've still continued to deliver. We rebalanced a lot of the Mag 7 back in January. Primarily not because we didn't like it anymore, but it had done so well in 23 and 24. It made sense for us to take some money off the table, look to other areas of the economy here and also overseas. We still think we've been favorable on utilities, as your last guest was as well, all year. And we've liked industrials. We think there's growth there. But I think you've got to be still selective in some of the areas of tech. But a lot of tech is also looking attractive now as well. So I think there's a lot of places that investors can look. And again, overseas, we think most investors are grossly underweight overseas, have been for a long time. And the returns over there haven't been bad. I mean, a lot of people talk about how bad they've underperformed. But the last 3 years have seen Germany, Spain, Austria, Belgium, and Poland all outperform the S&P 500 when nobody owns them. So I think it makes sense to have some money out of the country, to kind of complement what you've got here.
Yeah. You did have some stock picks. You had Cintas and Rheinmetall and also Parker Hannifin. Tell me about each one of those names. Do you think each of those can gain 10%, let's say?
Yeah, I mean, I think in the case of some of those, obviously over a longer period of time, more. I mean, Cintas is one of those businesses. You see the trucks around all the time. They've got a great core group of clients. And what happens is once they get into your business, they keep finding more ways to sell you things. And so they're a business that's really tough to move off. Once they get in, they're looking to do more and more for you, consistent double-digit revenue growth and EPS growth. I don't see why that can't continue. They're a staple, basically, in American businesses. Rheinmetall is a name we've liked for a long time. They benefited from, obviously, Russia moving into Ukraine. It's a German arms maker. They benefited more recently when Trump has talked about making Europe pay for more arms and more of their own defense through NATO. They can't make it fast enough over there. And so I think that's a business that continues to do well, forgetting just the wars that are going on. But if Europe becomes more responsible for their own defense, Rheinmetall is one of those businesses that has to do well, and we think it will continue to do well. And Parker Hannifin, again, they've got some business in the industrials, HVAC, aerospace, defense, all businesses that are, I think, important with this reshoring. It's kind of a quasi-AI play in that a lot of this stuff, when we get into reshoring, it's back to cooling and electrification. Their defense business is solid as well, and it continues to plug along. These aren't sexy names, but I think they continue to do well in whatever environment that we get into, and certainly will do well with less regulations, which I think we're going to see in the back half of the year.
A lot of folks have liked defense stocks at home and abroad too, right?
Yeah, I think the difference here is there was a real catalyst with Rheinmetall. We've owned Lockheed for a long time. I've got no issues with Lockheed. Opportunity, and a lot of more incremental dollars are going to go to some of these foreign plays because of the U.S. saying, hey, we're not going to pay for you anymore. We're wanting NATO to increase the amount of money people are spending on defense. That's going to go specifically to a lot of these companies that are primarily located in Europe. I think they're going to say, if you're making us spend more, If the U.S. is, we're going to spend it with European companies. So yes, I think by and large, defense is a good place to be. Rheinmetall happens to be one we've liked for a couple of years. We still like it. It's probably our top defense name because I don't see really a reason for it to stop going higher, given kind of what's going on in the world.
And last but not least, I mean, I've been asking everyone, do you think that at the end of the year that we are in fact higher than where we are today?
Yeah, I would believe so. I think what you've got now is once we get through some of this budget issues and hopefully this bill comes and we get it signed, I think the back half really is attractive when we start to see some of the deregulation that was really the hallmark of the first Trump presidency was deregulation came down. That opened up some of this, animal spirits, for lack of a better word, within stocks. So I think that's positive. I think we're not heading into anywhere near a recession. I think the bond market has shown you that. If you're positioned for a recession, last time I saw you was early April, and we had people talking about recession. If you're positioned yourself for recession at that V bottom, you're pretty discouraged now. We see GDP slowing a little bit, but then ramping up probably in the first quarter of next year. No recession in place, so I think it's a good spot to be. And I think most investors, again, need to look away from where they're overweight, which typically it's Mag 7. Look to some other sectors to get good returns and diversify yourself. I think you'll do well in the second half of the year.
Michael Landsberg, thank you so much. Chief Investment Officer of Landsberg Bennett Private Wealth Management. Thank you, Michael.